Hello, hello. Good evening. Thank you for joining us this evening. To all of our students, faculty, staff, startup ecosystem, community supporters, we're so glad you're here. My name is Ashley Jennings, and I'm one of the program managers for the Kelleher Center for Entrepreneurship. HKC is a resource here on campus for all undergraduate and graduate students, and we have a menu of resources. If you're a founder or entrepreneurially oriented, have an idea that you're trying to bring to fruition, we have entrepreneurs in residence, legal workshops, startup workshops, pitch competitions, travel grants if you're looking to get somewhere and pitch for capital. We want to help you get there. And speaker events such as this. This is one of our annual speaker events, MoneyTalks, and we're especially excited to partner with the Social Innovation Initiative out of McCombs on this specific one. It's sure to be a powerful conversation, and without further ado, I want to just talk real fast about the competition going on too. Tweet, please live tweet throughout the conversation. If you wouldn't mind following the Kelleher Center, snap a photo, tag McCombs Social Innovation in your tweets, and use hashtag what starts up here. We'll be giving out a prize at the end of the conversation. So again, take a photo, follow us on Twitter, tweet away, hashtag. Without further ado, who will be leading our programming this evening? Dr. Meeta Kothare.
Hi, everybody. It's very nice to have you here, and we have an all-star panel for you. I'm really excited that the Social Innovation Initiative gets to host this with HKC. We are very close in terms of the work we do, but the Social Innovation Initiative is interested in social and environmental impact through business innovation. So we focus on social entrepreneurship, but we also focus on impact investing, corporate sustainability, circular economy, regenerative economies, and capitalism. So we're really excited to have this evening with you today. Like I said, this is a cast of who's who in the impact investing industry, and I'm just going to get started. I will introduce myself first. I'm Meeta Kothare. I'm the Managing Director of the Social Innovation Initiative at McCombs, and I also teach both at McCombs and at the LBJ School classes on social innovation and impact investing. Now I'm going to head over to our panel and let them introduce themselves. Amy, you go first.
Sure. Hi. Hopefully you can hear me. Yep. Hi, I'm Amy Bell. I'm a senior director with a group called Tideline, which is a consultant firm in the impact investing industry. We work with asset owners and asset managers and help them determine how to do impact investing strategies.
I'm John Thornborrow from Austin Impact Capital. I'm an angel investor in Austin, and I teach at in the LBJ School a social entrepreneurship course, which is also cross-listed to McCombs.
I'm David Robinson Jr., work for Admiral Capital and Blueprint Local, and focused on investing into communities here in San Antonio, Austin, Houston, and I went to school here at UT.
So 3 UT grads, all stars in impact investing. How cool is that? Okay, well, we'll start at some basic level of what impact investing is and so on, and then proceed so that everybody is on the same page, because there's so much to discuss. We will have a Q&A at the end in about 45 minutes, actually less than 45 minutes, so please queue up when you're ready. Let me start with you, John, and since you're the teacher in this group, let's talk to you about what impact means, what is impact investing, what does that support, and what do you do in that space?
Great question. So impact investing is obviously working with companies that have more than a financial incentive, financial bottom line, and doing something that's worthwhile for environmental, social, or governance issues. And that can mean a lot of different things. It's such a broad space. I think it's important for entrepreneurs and investors both to really think about what their sort of core issues are that they're trying to tackle. It's hard to really address all social issues. So most investors you will find have some investment thesis or core set of issues that they're working towards, and certainly entrepreneurs who develop a deep expertise in a particular issue area have, I think, an advantage, just being able to sort of network and create more systems change when you focus on a particular area. For me, sort of thematically, that reads healthcare and education. I know those are still very broad categories, but in the total universe of issues, there's still two that are important to me, and that sort of the connection between the head and the heart. It has to be part passion. It also has to be part sort of economic return. So I sort of represent in this group the angel investor persona, if you will. I think Amy and David have much more of a family office sort of institutional lens and knowledge set. And what that means to me is I work with early stage entrepreneurs. Usually they're just starting. Maybe they have an organization, maybe there's some revenue, very early sort of minimally viable product. But so for me, it's really important to believe in that entrepreneur. That's probably the most important criteria. I think it changes as organizations develop along the maturity curve, and let Amy and David talk to that. But for me, it's really about the entrepreneur. I have to believe that that person, when the inevitable pivot comes along and things change, and they're going to change, that they're going to figure it out and they're going to break through those barriers. So there's not a whole lot else to go on in the early stage, so I have to believe that the entrepreneur is going to get it done. So I'll stop there.
And then that's John's slide from the blog you wrote for our Innovator, which is our newsletter. So that's why now you know where he works in that space. So moving on to you, David, what is the space in which you invest? Let's talk a little bit about building up communities and so on through impact investing, where John focuses probably more on social entrepreneurs, startups. What is your space?
Yeah, I think maybe some background might be helpful as well. So, my father played basketball for the Spurs, and he was really, one of his main passions was education. And so he, when he was playing, he saw on the east side of San Antonio, it was kind of a very classically redlined area of town. They built 281 and just cut off the black section of San Antonio and really left that, and it had been very underinvested. And so probably for a good 40 years had not seen any investment, and had really fell into despair. And so he kind of had a vision for that area and built a private school and built this beautiful $10 million campus, 100 kids in this faith-based private school. And fast forward 20 years now to this day, for him to be a first mover in that area has changed everything. And now housing prices in that neighborhood have tripled, and it's similar to East Austin, where people look up. For so long, suburban areas were so attractive, and everybody wanted their one little plot of land and their car to take them out to it. But millennials like us want to be closer, and so places like East Austin, places like East San Antonio, if you can be 10 minutes away from the Alamo, that's actually really, that's really attractive. The problem is there's families that have been living there for generations when it wasn't very valuable. And so I think what he did, that was building a school with philanthropic money. And I think over the last 20 years, we've really been thinking about how do we engage more of our dollars to make impactful change. And I think a big part of impact investing is, for so long, even for Admiral Capital, we've raised 2 funds with USAA investing in value-add real estate, but the mindset was make money and invest in for-profit investments, but then take 10% of our firm's carried interest and look to do things in the community, whether it be support schools or can we daycares or things like that, purely philanthropically, but really waking up to this impact investing world, saying are there ways to use more of our dollars, more capital for things that are alongside our mission. And so I've been in New York for the last 3 years, and then just moved back in January to work on a new project called Blueprint Local, which is a fund focused on investing in opportunity zones, which we might get into later. But the idea is to really invest with density and invest across businesses and real estate in a very local area, finding a half-mile radius, and then looking over a long period of time to help create some economic dynamism in that area. Whereas if too much money comes in too quickly, then it can create a lot of discomfort and I guess uneven growth. But if money can come in slowly and responsibly into areas, the goal would be to have inclusive development. And so we're thinking through that, with the Opportunity Zone capital, can you have your for-profit dollars actually go into something that you believe in, like education technology or affordable housing, or into your local community? So
since you started on that,
yeah,
let's talk a little bit about it. Just explain to the audience what Opportunity Zones mean, and then we can get back to it later.
Yeah, so at a very high level, in 2017, they passed a new tax bill that cut a lot of corporate taxes. And so if you are going to push money out of the public sector and into the private sector, you have to incentivize private sector dollars to address public needs, which I think is a lot of impact investing. So there's a lot of thought about, like, how do you incentivize people to invest in public sector needs, things like affordable housing, things like healthcare, and charter schools are a good example. So for Opportunity Zones, over the last 10 years since the recession, there's been a lot of money made by a very small amount of people. So coming out of the recession, if you had money to invest, you could invest it in real estate, you could invest it in private equity, and people have made money hand over fist. So people have a lot of capital gains, which is the money that you make, the money that you get taxed on from the money you make investing. And so you get taxed at a pretty high rate on that, 23.8%. And so people don't like paying those taxes, so they leave a lot of that money locked up. And so at the time of the tax bill, they did a study, and there was $6 trillion between individuals and corporations that were unrealized capital gains. So if you were, Mark Zuckerberg, and you have a bunch of Facebook stock that you got at a really low basis, you don't want to pay that tax. You don't ever want to sell that Facebook stock because your tax bill is going to be in the millions of dollars. So you just leave that sitting there in the stock market, and it doesn't do anybody any good. It's just sitting on paper. And so there's just a lot of that wealth that's been created that wasn't doing anything for people. And so what Opportunity Zones did is they designated over 8,000, I think it was 8,700 zones all across the country. So East Austin and downtown San Antonio and the near west side in San Antonio and kind of South Congress area. All over the country they have these zones. And so if you invest in these zones, it can be in real estate, in businesses, it can be any kind of equity investment, and you hold for a longer period in time, you get a tax advantage. So really the idea is, can you make people look at things with a 10-year horizon or longer, and then you can have a very advantaged investment. So the idea is, can you invest in low-income neighborhoods with a long-term view?
So we'll get back to Opportunity Zones, because I know all three of you are fairly well versed in it, as much as any one of us can be today. But I want to give Amy a chance to tell us a little bit about the work she does now. But one question I want to pose to you, based on what David said, we're talking about the federal government giving incentives to develop communities, to invest in communities. Is it necessary to provide incentives to impact investors in all markets? Is it true that impact cannot be achieved without taking some concession in financial return? Or is it possible in certain cases to have both financial return and impact?
Yeah, it's an excellent question. So for a little bit further background, I've been working in the impact investing industry for the last 10 years. Managing investments initially for JPMorgan Chase for 7 of those years in emerging markets, as well as here in the US across a number of different geographies and sectors. And then now in my role at Tideline, advise a number of very mature mainstream family offices, asset managers, foundations, basically groups that are looking to put capital to work. So there's a whole range of things that they sort of look at in terms of investments. So to come back to your question in terms of when is this type of incentive necessary, I would say that, as John articulated, there's a really wide spectrum of things that fall into the definition of impact investment. And what unifies them is this idea that you're sort of pursuing as part of your impact strategy, both a financial return and then some type of impact, whether that be social, environmental, some combination of the two. And the reality is that there are businesses that exist today and funds that exist today that are able to deliver what is an appropriate risk of return, or rate of return, excuse me, based on, dependent on what type of investor you are, that's also going to achieve high impact, where there's no need for that type of intervention. On the other hand, there are a number of huge, intractable social environmental problems where investment capital has never flowed. And in some of those issue areas, I would say there's a need for that type of incentive or subsidy to help incentivize capital to flow there, like what's happening with Opportunity Zone as an example. And the hope is that once capital starts to flow and investors recognize what they perceive to be a risky situation to maybe not be one, that there's less need for that type of subsidy or incentive to be in place. And then there will be interventions where you will always need a permanent subsidy. If you think about, for example, delivering, the last mile distribution for drugs and vaccines in the developing world, until massive amounts of infrastructure are built, or there is some incredible innovation where we don't need to truck things out to rural villages for people to have access to those types of medicines, there's always going to be need to be some sort of incentive to provide those and some level of philanthropy as well. So the answer is sort of mixed depending on what you define as your rate of return and what you're looking for, and then what the underlying nature of the investment is. But there's definitely everything that exists from that full-on market rate of return to very concessionary style return as well, where incentives can be really powerful in getting capital to flow.
So one of the incentives besides federal regulation is the idea of philanthropists coming in and incentivizing impact investors to come in. John, you've worked in the philanthropic space as well in venture philanthropy. Will you talk a little bit about that and its role in creating that first risky capital for a certain project that might be attractive to impact investors eventually? And is that model something we'll see more of? Where is that going?
It's a great question, and I think it is something we'll see more of. So if you think about sort of the spectrum of investments from pure venture, which is agnostic to impact, to the other side of the spectrum is philanthropy, which is all about impact and agnostic to return. There's starting to be a middle ground, and I think the impact space is sort of that middle ground of for-profit social impact is a dual or triple bottom line. There's a financial motivation and there's an impact motivation. But as you start to cross the line just over into the nonprofit space, there are a growing number of nonprofits that have a viable business model. They have a fee-for-service model that can help them scale and become less reliant on philanthropy. And that's not to say that they will ever do away with philanthropy completely. It will always have a role. But as one of our peers, Susie Sosa, is fond of saying, if you're a nonprofit in this space and you have the ability to generate an earned revenue stream, you should. You actually have an obligation to do that, to sort of free up the relatively fixed pie of philanthropy that's available to all nonprofits. So as you see nonprofits start to develop actually business models around how they provide their services, then there's an opportunity for impact investors to come alongside and actually fund that growth, just like they would in a for-profit. Organizations that are sort of early in those models of developing earned revenue may get an impact investor interested in helping them scale. If they're not quite ready, that's where philanthropy can still be that catalyst funding to help an organization get to the point where their earned revenue model is starting to work and they become more self-sufficient. So yeah, this notion of venture philanthropy is sort of working with impact investors as well as foundations that are taking a different view of how they can use their funds to make catalytic investments. And an example might be a foundation that makes, instead of making a pure grant, they decide to make what's called a program-related investment into a nonprofit that they could get a return, like a recoverable grant or a loan, or they can actually be the core risk capital in a pay-for-success model. And Amy's much more expert in this area than I am, so I'll let her talk about that. But there are new ways of philanthropy to kind of to be that catalytic risk capital in situations that are helping the nonprofit sector and bringing alongside impact investors to do that.
And maybe just to reinforce John's, I think, right intuition and knowledge that this is something that will continue to grow. The Macarthur Foundation, for those of you that cover this space, will have seen this more recently, but just released a pretty significant report about the nature of catalytic capital and sort of a call to action to other foundations and other very mission-driven investors who have that flexibility around return and timeline to actually provide that type of capital, because it's a way to pull in much larger pools of money than you can do through philanthropy alone. And there's a similar, very complementary initiative, very focused on the emerging markets around blended finance that a lot of the development banks have taken up. So there's a recognition of the power of this type of money, and just a call to action to those that have the ability to deploy it to actually use it in that very catalytic way.
Yeah, and I think one of the really impactful examples that I've seen is the Ford Foundation. I was in New York and seeing they committed $1 billion of their endowment to affordable housing and financial inclusion. So like solutions, for-profit solutions, but out of their endowment. And usually, for a foundation or a university like this, you have an endowment, that money is not getting taxed. And usually it is held by a money manager, and their main job is to create an appropriate amount of return. You say, I need to get 8% to be able to give 5% away and then beat inflation. So if you have $100 million in a non-taxed entity to do good, say save the oceans, and then 5% of that is going to actually save the oceans each year, and then 95% of that is just cold make money. It's like, well, or if there are ways to do more with that are more in line, can we? And I think for a long time people had been very resistant, but now there are a lot of options and a lot of product, and people are, I think, being pushed to be more creative and you do the extra work to figure out, how can we put the bulk of our dollars towards things that we believe in.
And that's a great segue to something that I wanted to ask you, Amy, as well. We talked about the spectrum of impact investing. There's the one end where you don't need to have any concessions made, and the other where it's pure philanthropy, and then you kind of go up that spectrum. But when we think about that non-concessionary public market investing, which we call ESG investing, and I'll let Amy talk about what that means, the question I would love to have, and I'll pose this to the whole panel, but people think about that as a separate part of the world. That's public equities, public debt. But isn't it true that foundations like Macarthur Foundation have been, or Ford or Rockefeller have been behind that pushing asset managers to really invest with ESG considerations?
Yeah, so it's actually, they're getting pushed, I would say. I mean, the Ford Foundation is really unique in having $1 billion allocated out of their endowment, because the endowments effectively are just another institutional investor who has a mandate, a fiduciary duty in some cases, to deploy money and to maximize shareholder value. And that has been interpreted up until very recently to mean purely profit. So value was just the financial economics that you could generate. And I think what has happened in the last, call it decade plus now, that impact investing has sort of taken hold as a way to talk about this type of capital being put to work, is it's shown a light on activities that were already happening in the public markets around ESG, which refers to environmental, social, and governance risk factors. To think about those as ways that you could also be promoting impact. So for a long time, ESG, what that really entailed was screening out bad stuff. And that's still a very significant part of what happens in public markets today as it relates to impact, which is looking to sell off or to de-invest from things like fossil fuels, from tobacco, from apartheid was actually a really early one in the 80s, to divest from those. And that continues to be a significant movement. What started to evolve from that is also looking at those factors around environmental and social and governance issues as actually positive factors. So rather than just screening out the bad, what if we actually look to activate around the positive? And so there's been a number of activist shareholders and groups. There's some institutional investors who sort of taken a stand on issues like this, who have advocated for changes around those, to compel businesses to really think about that. And then there's a number of management teams in corporates who represent those public equities who see an opportunity. They see climate change as something that's actually creating unique business opportunity and to create the technologies or the solutions that'll respond to climate change. You see businesses that have significant supply chains in the emerging markets thinking about human rights issues and trying to do better by the countries and the people that they operate with. And so those types of activities are really creating sort of positive change. And what's been really sort of lovely about impact investing as sort of the new kid on the block in 2007 sort of coming into is it provided a way to start to talk about this as a spectrum that John's referred to, whereas before you had sort of like ESG and negative screen, and you had some like venture philanthropy people over here, and you had community investing in the United States, and you had environmental clean tech investors, and now all of those investors are part of this really big, very confusing big tent of socially responsible, sustainable impact, whatever you want to call it, investing. But I think what's exciting is that because there has started to be so much energy around the market, is you're starting to see more product creation that starts to bring those together. And I think the push from investors, whether we're talking about individuals, family offices, or more institutional investors, is for that impact to be authentic. So that I think there's starting to be a lot of energy around trying to create accountability that would then lead to real creation of impact in the way that we hold all of our managers and investors accountable for return.
That's a great question, a topic to discuss, and we could spend a lot of time talking about impact measurement and so on, and I will get Amy's opinion on this because there's a very specific thing that she's been working on. But David, when you think about this impact, what do you feel about the impact investing community as a whole, and how do you specifically think about impact? You're so much more connected to local communities and you get to see it. There are impact investors who invest in areas where they have never been and don't see. So what is the special angle that your work brings?
Yeah, I mean, it's really blurry. I mean, at the base, it's being conscious and just realizing that, it's not just finance. You just cannot think in a vacuum thinking, okay, I'm going to make this return and there is no other, there's no other consequences. And, I think for us, it's been a really interesting learning journey, just as a family, because understanding that it's all driven by market. And so if there's investor demand for something, there will be more product for it. And so, right now it's been interesting to see, pension funds in Europe and, there's to really say, this is what we want to invest in and go figure that out. Because when they go and tell their managers, figure it out, they go and figure it out. This is, if there's a couple $2 billion on the line, people are incentivized to go find ESG product, and then that drives the rest of the market. And so now, in America, so much wealth is coming into millennials' hands and women for the first time, and they're saying, I want to invest in my community. I want to invest in things that I care about, and firing their old managers if they don't have that solution for them. And now they have lots of options where they can go and find somebody who will actually take care of them. So I think there is this big dynamic where the market's driving a lot, but it means a lot of different things to certain people. So, for what we're working on, it's much more of a local focus. So saying, how can I invest in Texas? If I want to invest in San Antonio or invest in Austin, what are my options? And there's really not a lot of good institutional quality options to invest in your local community unless you wanted to do a direct real estate deal or a direct venture deal, which most people usually get burned on. And so how can I get a diversified portfolio in Austin, Texas? That's really hard. Whereas, a lot of the way just things have happened, like there's a lot of money here in Austin. There's a lot of money in San Antonio and Chattanooga, Tennessee, but they put their money with JP Morgan, nothing against JP Morgan, but they put their money with a wealth manager who then takes but they put their money with a wealth manager who takes their money to New York and then diversifies it across the country. So you have the millions that were made in San Antonio don't go back to San Antonio. They go all over the place, and they go to the tried and true places where the people in New York think they can make money. So you have downtown Austin getting overblown because the same investors are going to the same fishing hole. But there's value other places. There's smart entrepreneurs in Atlanta and in Louisville and all these other countries, in all these different cities or countries. So are you willing to do that extra work to go find that value? Yeah. So I think for it's interesting to see all of this evolve, and it's not just from an impact standpoint. I think there are strong financial standpoints. Another example is for a workforce housing. There's been so much value add. So people coming in, they see a apartment building that's built in the 80s and rents are at $900, and the normal real estate mentality is, oh, if we put in $10,000 a door, we can jack up rents another $200 and put it in a new lobby and a gym, and we'll be, we can sell it in 3 years and we'll be doing well. It's like, well, people will always need $900 rents. There's always going to be teachers and firefighters and people who want that rent. So how long are you going to have yuppies with tech jobs that are going to want to pay $1,300 for a one bedroom? You don't know that. And so when the water comes out, those are the people who get exposed. And that's what happens in recessions, where people just follow the money, follow the money, follow the money, and they're just following returns, and then they get exposed and washed out. So I think it's a balancing act, and I think people are looking at it, much more returns driven or just a de-risked driven mentality as well.
Yeah. So give us a couple of examples of what you've done recently that you've been excited about.
Yeah, okay, I guess a couple from the different spectrums. So we have a foundation that's in San Antonio focused on education. So it's really to support the charter school system, and actually they're here at Idea Public Schools. So that original private school was called the Carver Academy.
I don't know what you gave us.
I don't know.
David.
But that original private school.
Stuff that's not on there, but never mind.
That original private school is now part of a charter school system called Idea, and they've grown, and it's fantastic. But we have a foundation that's supposed to support that, and we had it with a very traditional money manager, and we fired them, and then hired a new group called the Caprock Group, and so now we're transitioning that to 100% impact. And so, started with ESG with our stocks and stocks, and for the foundation, your public equities is a good 40% of that. So when people talk about ESG, that's a major part of your public equities are a major part of your dollars for anybody. So we started moving that to have an impact theme, and then we just made an investment in a fund called Learnstart Capital that is an ed tech venture fund. So they're very much market rate looking for innovative new solutions across the world in education, and then invested in Owl Ventures, which is another education technology fund. So that for a foundation supposed to be focused on education to making venture investments in funds that are looking for catalytic ways to change education is exciting. And then we see all these fun companies, we can bring them to the charter school network and say, hey, what would you do with this, or what would you do with that? And it's just been a very fun exercise. And then for Blueprint Local, that's a whole nother thing.
Yeah.
So that's really focusing on cities and specific neighborhoods here in Texas. So downtown San Antonio, kind of East Austin, and then in Houston, the Second Ward, trying to figure out, can we find half-mile radiuses to invest heavily in, so across real estate, across businesses, and hold those investments for 10 years to really think about how are we catalytically changing that neighborhood, but in an inclusive way. Can you structure things so if we own a building, and there's a retail tenant who's a local coffee shop, can we structure it so that that coffee shop can, instead of just paying us rent, pay into an escrow account where they are leasing to own that in 10 years, and we can hit our number that we need to hit, but they can then own their space. But that longer horizon allows you to be a lot more creative versus, usually in real estate you have that 3 to 5 years, and you're looking for the next person to sell it to, and you don't really care what happens. You see that in Williamsburg, people trade buildings like bonds, and it's not good for the community in the long term.
Yeah, and this is actually a good question for John as well, because you're talking about finding these entrepreneurs. In ed tech especially, or in the education field, not so much in healthcare, but in the ed field, entrepreneurs seem to be having a really tough time getting investors to invest. There's this part that is, I think there's a sense that you shouldn't be making money off education. Their partners are public schools. They don't want to pay. There's a sense that we shouldn't be investing in these companies that are for profit, whether they are suppliers to public schools or schools themselves. So how do you approach this as an investor in education?
That's a tough one. Education is changing rapidly, as is healthcare. You mentioned both are interesting for me. I think educational institutions have to have partners as well. And I think the face of education is changing dramatically. We see it here in the university. We see it, in secondary as well. There's a much more virtual mentality to how education happens, and the value that educational institutions bring, has to be more than a credential. And it's changing rapidly. One of the investments that I have is in a company called Pen Pal Schools, which went through the TechStars program. Talk about sort of incubators as well. What's that?
I worked
at Pen Pal?
for Joe, yeah.
Excellent. And they are taking sort of a different approach to international education by connecting schools and students with content that they are bringing to their own platform, and it's available to teachers to bring into the classroom. So many more tools are available for teachers to bring in, broaden the horizons of students, and and make them sort of globally aware and global citizens early on in the process. That's just one tiny little example of how sort of the face of education is changing through technology. But institutions have to have partners, and to say, why shouldn't be selling something to a school because they don't have any money is sort of defeating the purpose of bringing the technology that's available to every other industry to education. So, but it's a tough question as to sort of what particular lens you bring to the industry.
Right. So what is the general, you mentioned having to trust management, that you are really betting on their talent. What else do you look for in an entrepreneur?
I think it depends on the stage, again, of the company, right, and the type of investor. And I think it's really important for entrepreneurs to understand the whole capital spectrum that they're working within and when to raise the right kind of money. So when I say, it's a bet on the entrepreneur, I'm talking about very early stage organizations where you might have a founding team, the product is very immature, maybe they don't have very many customers. There are so many things that are going to change in that business model that you've got to go sort of with a few criteria. And first and foremost is the team and the entrepreneur, as I said earlier. Second for me is I have to believe in the impact. It's sort of the head and the heart again. If I have to understand the business model, but I also have to be connected with the impact that they're trying to create. And that sort of impact measurement, I think, as David alluded to, it's really hard. It's very subjective. Amy's kind of an expert in this area of evaluation. I don't know of very many investors, impact investors or institutionals that measure impact well. So when it comes down to it, you've got to make a gut choice about the impact that you're trying to create and sort of enforcing, trying to get them to work harder to measure, but it's super difficult. And then sort of the other typical, do they have product market fit? Is there an early product that's got some traction? Is it in a big enough market that they can have real impact? But those are so early, and as David alluded to, there's so many risk factors as you just have to have many different bets in the area because there's so many things out of an entrepreneur's control and an investor's control. Competitive risk, market risk, timing, those things can send a company sideways or under, and you just have to be able to spread it around a little bit, not bet it all on one early stage. But as companies grow and mature, they get access to new forms of capital. They get access to early stage venture capital and then ultimately institutional capital, family offices that makes, and they have a whole different set of criteria.
But to kind of your point, I think when a company, like say a company's focused on clean tech, and there's these UN sustainability goals, the SDGs that are big, and everybody's kind of getting behind saying, these are the things we're going to get behind as countries, as investors, and support companies and solutions in these areas. If somebody's doing a wind technology, I think there's going to be momentum in that market. There's going to be wind behind their sales as a product versus somebody who's creating a firearms business. Like, well, you might have some regulatory issues in the coming future. I think some of the impact, the problems that impact companies are trying to solve have a lot of wind at their sails from a regulatory standpoint, and that could make you feel better about it.
I think it's certainly helpful to map across some rubric of impact, Gen Iris or Sustainable Development Goals, and to be able to communicate that to your investors. I guess my point was at the end of the day, it's really hard to measure what impact did they have in the community because there's so many tangential forces that are creating that impact. How can you say that you created, right? What is the change in the community that you created? And making that connection is incredibly difficult. It's difficult for nonprofits as well that are doing direct benefit services. So you should, as an entrepreneur, map your strategy to some rubric of impact goals. How you ultimately get from here to there and what the impact you're creating is the really tough part.
Absolutely. So since we're talking about impact measurement, of course I have to go to Amy. Amy has been working with a large number of people on the Impact Management Project, which is an effort to get the industry to some standardization around impact measurement. So I'm going to let her talk about it a little bit and anything that you want to follow up from what John was saying.
Yeah, no, happy to. So I think John is right that there aren't a lot of people doing impact measurement well, and there's been a lot of debate and discussion within the industry about the right ways to go about that, and how do you provide investors with the tools that makes it easier for people to sort of confront this, because one of the biggest barriers to people thinking about deploying this type of capital is the sort of getting through that mind-twisting concept of like, how do I measure my impact, and what is my impact, and then how do I know if it was even good or not? And so the initiative, the Impact Management Project, is meant to help do that. A lot of what existed today, so even what you have through something like IRIS, which is a set of metrics that exists, the Sustainable Development Goals themselves, the SDGs, they're ultimately the outcomes or the outputs, the things that you might think to measure on the backside. But it's hard to measure something if you don't know what it was you were intending to do at the front. So what the effort behind the IMP is really to provide people with the lexicon and with the process and framework to actually define what is the impact that I'm looking to achieve. So if I'm really interested in education, am I interested in seeing improvements in educational outcomes? Am I improving and seeing educational access provided to lower income populations? What are the types of things that I sort of think of as being ultimately the change that I would like to see occur because of my investment? Whether I can directly attribute my capital to having caused it or not, if I could at least feel that I was contributing to something that would lead to those outcomes, can I start to articulate those? And it sort of boils down to the sort of the who, the what, the why, the how. You'll see this all written in much more beautiful font and articulation than I'll do here on stage on the IMP website, but it sort of gives you that sort of first set of break down the elements of what I'm trying to achieve from impact. And that's a process that at Tideline we've walked a number of clients through. I did this myself when I was at JP Morgan, but actually helping them come up with what we call your impact thesis or your theory of change. Because if you don't know what it was that you were looking to do in the first place, there's no point in measuring it on the back end. And I've seen a lot of people who start with a really beautiful list of metrics and then don't really know what they were looking to achieve, and so then it becomes really hard to actually do that. I think the second really big challenge that I see in impact measurement and management that the IMP doesn't quite yet solve for, and really will just come through additional development and maturation in industry. So assuming you can get to this point where you can measure the type of impact that you're looking to achieve, is how do I know that it was actually good, right? So if you go to an advisor and say, I want to invest my money, and one of the first questions your advisor is going to ask you is like, well, how much do you want to make? And you might define that based on how much you think you need for retirement. You might say, well, I know that private equity makes X%, or I know that fixed assets usually make this type of money, and so that's what I'd like to make. With impact, we don't have that track record to really look at, because this is still novel and new to be thinking about tracking investment capital as it relates to the impacts that are created. So when you go and you think about doing an impact investment and someone says, well, how many kids would you like to help? It's like, well, I guess as many as possible, which is a really hard thing to measure.
But the answer on the financial return is the same.
As much as possible. That's true.
With the risk I'm going to take.
But you have some realism about what as much could be, whereas in the case of the impact, I think it's hard to know, what is that really, what's really possible there. So I think one of the efforts that's starting to happen in the industry is to try and provide more transparency around impact, which means having more rigor and consistency in how the processes are laid out. There's a really neat initiative that got launched earlier this week that speaks to this called the IFC led it. It was basically they set a set of operating principles for impact measurement and management, and what it means as an institutional investor to do that, and it includes having verification in the process. It includes defining your theory of change. It's a really useful sort of document to look at, and there's quite a lot. They basically put all of the impact investing literature into a single document, so it's pretty meaty, but it's a good one-stop shop for what is this whole market that we've been talking about, and they talk about what a rigorous, consistent process could look like for institutional managers. So I think things like the IMP, efforts like that to really bring standardization to the market, it helps to ensure that, one, most importantly, the impact is going to be authentic and real. That's really important. Otherwise, why are we doing this in the first place? And that, two, we're starting to provide information to the market that makes it easier for folks who aren't like David and John, who are pioneers and really on the cutting edge and wanting to push the boundaries, and to make it more comfortable for those that are sort of sitting on the sidelines and saying, this is interesting, but I need more comfort to sort of come in.
Mm-hmm. Gosh, there's so much more I want to talk to you about, but I think we have to go to questions. Is that right? Looking in the back there, people waving at me. Hopefully some of the things I wanted to ask you about will be asked by students. I should have planted some, right? Okay, Madison's going around. Madison, to your right.
Thank you all very much. Also exciting to see somebody from San Antonio up there. Woo. I would love to hear your thoughts on how we can enter the space of impact, either as hopefully some of us that are graduating, joining firms that are offering these kinds of products, or just as investors. It sounds like a lot of what's being offered right now is very early stage. It's private markets. Besides ESG, when or where and how can we start seeing bigger opportunities for investing in this, or is it just too early in the market right now?
I'll start. It's not too early. I think so what I would say generally about careers in, we'll say impact investing in a very broad way, is that it's still a relatively small job market with a lot of competition, because understandably this idea that you could use something that you're good at to then contribute to something that would create impact in the world really resonates with a lot of people. So I think but that being said, I think there are a lot of really interesting ways that you could intervene. You could certainly be doing this as an investor, and that's great, but if you're going to be an investor, you better like Google documents and you better like Excel models. That's basically what I spend most of my days doing, and I'm sure these guys spend a fair amount of their time doing it, but there are also lots of other things that people do. We have, thinking about JP Morgan, for example, the corporate social responsibility group there, which is not necessarily the place you might think to go if you were interested in impact investing, because CSR has a lot of connotations against it, has really talented people who are issue area domain experts on things like financial health and workforce, where increasingly impact investment is being used to actually promote those and not just traditional philanthropy. And so they're looking for people who have knowledge in those areas and want to put it to work. There's interest in general, I would say, across the financial services industry. Every asset manager is now thinking about impact, whether they're looking at it from a public equities lens, if they're a fixed assets investor, if they're doing private markets. So there is an opportunity to sort of come in and sort of learn from the ground up and get some of the technical skills that you would need to do that, and go from there, and then look for ways that you could sort of plow in. So I do think it requires being a little bit creative. I think it requires you knowing a little bit about what it is that you do that's good, that you want to learn to do more, and trying to put that to work. And then finding a role that would let you achieve that. And there's lots, these guys can talk a little bit more about what they've seen, but that from coming from more of a financial services standpoint, that's how I see it.
Yeah, I think you alluded to a number of different areas of the sector, and it's still small. I don't know if you have current information, but I seem to remember maybe it's 150 billion or 200 billion of impact capital.
It's 500 billion now.
500 billion. Okay.
Yes, this year.
That's great.
As of 2 weeks ago. Yeah, it's
500 billion
crazy.
of the public markets, which are how many? $60 trillion.
$60 trillion.
So it's growing.
Given
right?
it was 40
relatively
million
small.
6 years ago, it's pretty awesome.
It's growing fast, which is great. But I think there's an emerging sort of ecosystem of institutional investors. You can go sort of institutional side, right?
Yep.
There's a growing ecosystem of advisory firms, which is great. Rick Davis is in here somewhere. He's with Lohas Capital, Lohas Advisory, in the back. You're starting to see sort of firms now that are emerging as advisors in the space, whereas that whole ecosystem in the for-profit world has existed for. There's bankers and advisors and lawyers, and there's one. If you really want to go for the expert lawyer in town in sort of the nonprofit space, there's one or two of them, literally. So, but it's growing, and it's very encouraging to see the ecosystem develop. And I would say, just sort of when's the right time, or how would I advise somebody, is just start. You have to have an intention that you want to do something in this space. And I encourage people not to wait, oh, we have 5 years, I'm going to go do this job, and I'm going to establish myself here. Like, all that is well and good, but if you really want to do something in impact space, just start. Just set your intention to find something that lights you up, whether that's on, in small startups or as an entrepreneur, or whether it's on the impact investing side in an institution or in an advisory. There are a growing number of opportunities out there. They are competitive, but if you don't set your intention on it, it won't happen. So just start.
I'll throw one other quick idea out there, which is I started, early in my career, I was in the investment bank at JP Morgan, and I was really interested. I had a very clear intention around doing something connected to development or impact, but it was hard to conceive how to do that inside of mergers and acquisitions at JP Morgan Chase. But what was really great about the job that I had is I was considered a generalist, and I got to be somewhat choosy about the sectors that I focused on. So I intentionally sought out deals with healthcare, education, and power, because I thought those are all sectors that if I want to do something impact, that I'm developing some domain expertise and working with companies who may be on the forefront of that change and actually doing really positive things as a company that could lead to the path that I might go down. So that's another, sort of thinking about sectors. We've talked a lot about sectors that naturally lend themselves to that, but that's another interesting place.
And I would just add, they've talked about most of the important things, but I would learn a lot about policy. And it's not a new thing, but all of JP Morgan and Goldman, they have flocks of policy people, but a lot of impact investment is really leveraging policy. I mean, if you're looking at what is the U.S. Department of Agriculture and what are they supporting and what are they giving loans out for, and and a lot of this is really using the government. And I think it's only going to be more like that. I mean, there's only going to be more of programs like opportunity zones and low-income housing tax credits and new market tax credits. So really understanding that will differentiate you in a huge way, rather than getting an MBA or something like that.
So we have a few MBA empaths in this room. So
big
shout out to them.
Never mind.
Yeah, already doing it.
But
Yes.
but I think it's so policy driven, and that's what I've really been surprised in over the last couple of years. Just understanding how the government works and how to work with the government.
The whole community finance industry here in the U.S., which is 50 years of impact investing, they just didn't know it until someone called it impact investing, essentially exists because of regulatory intervention through tax incentives and policy.
Community Reinvestment Act. I mean, banks have billions of dollars that they have to invest in low-income communities, and that act alone did more than any one impact investor.
That's a great point.
And now opportunity zones.
Yeah, David's going to make sure it works.
That's right. I should remind people that they need to tweet to win prizes here.
So you guys keep talking about like middle ground and making money and the difference between social impact and making money, because obviously there's a huge gap between those two. So let's just talk about like what it's like for a regular entrepreneur to go and like try to raise money. They can go through and they do word of mouth, they go through and do angels list, they go through and like friends and family. How do people actually go and reach you guys? Is there a marketplace essentially like an angels list for social impact that goes through and talks about all the different grants that there's out there for the different ways the government helps? You talked about certain regions like San Antonio. I'm from San Antonio, so I totally understand what it's like to grow up in San Antonio, know the difference between one side of town and the other side of town. I was here early enough in Austin to understand between east side and now this side. So like, where are these people other opposed to just big money makers that can go through and help find people that are trying to do these investments and do these kind of things? Like, where do people start out from? I'm not personally looking for that, but I do have a marketplace builder that could go through and help people. I would be willing to give it for free just to help like socially impact the world for a better place. Where do people help find this? Is this something that can help people do more? Like where do you go from here?
I'd say that's a huge problem. And another thing that's blown my mind is, if you were looking to raise $200 million, you would be able to do it in no problem. If you're trying to raise $500,000, it's going to be really hard. There's just a lot of, I think there's just a lot of really chunky capital that, people are looking for larger opportunities, which is, and so for your, like on the ground level for your entrepreneur, it's really tough for the people that John works with. If you're trying to raise $250,000, there's just not a lot of options for you to go to, and not a lot of investors that want to spend the time on that.
That's true of investing in general.
Right.
Agreed. So that's venture capital is hard. Raising that type of money is just, is really difficult in general. And there is, I think, really poor intermediation at that level across the board, and it's not any better in the impact space. So it's just a lot of hustling and networking and trying to make that happen. I would say in the impact space, the Global Impact Investing Network is probably the best place in terms of some of the managers. They have a group of 60 or 70 that are a little bit more forward-leaning. They have another 300 that are sort of involved in the market. And there's some other places like that that you can start to see like networks of people who are active. But I think in reality, it just comes through really good networking like it does everywhere else.
Hub for people to go that are interested in like social impact, to be able to go and start finding information or meeting people or.
Impact Hub.
Well, yeah, so it depends on what type of, for fundraising, it's always going to be much harder, but like for just general information, there's an Impact Hub here in Austin. There are several of them across the country. There's other networks that you can join. I got involved with Net Impact, and they had a social, something about cores, service corps, thank you. Service corps is where you could volunteer with people and sort of do, and that was a really great network for me when I was living in New York and surrounded by investment bankers and wanted to feel a little bit more values alignment in my life. And so if you seek it out, I think it's out there, and there's increasingly more groups like this that are really engaged around it.
There's not a great clearinghouse of information. It's really, as you said, it's just like raising money in the pure venture space. You just have to get out there and network, and it's a process, and I encourage people to think about it as a sales process. You have a funnel, right? You identify as many people as you can, you get a pitch, you go start talking to people, and then every time you talk to somebody, you say, who are 3 other people I need to talk to? Who can you introduce me to? And get a warm introduction every time you're trying to build that network, and you're just searching for the right connection of investor to your mission and to your organization, and it's incredibly inefficient and really hard to do. And in the impact space, you sort of have the added complication that you're trying to match financial return and impact. Like you may have somebody who says, love your company, love your organization, not what I do from an impact perspective. So, but I can introduce you to somebody else. In terms of infrastructure and part of the ecosystem, Zoe wasn't able to make it tonight. She wasn't feeling well, but she's with Impact, Techstars Impact, which is a great organization. So accelerators and incubators can be a real leg up for entrepreneurs to get their business plan in order and build that network. Village Capital is another incubator for impact. Mass Challenge is here recently. So there are programs that now are emerging that will help entrepreneurs sort of get that next leg up and get that into those networks of investors, which you just have to get out there and talk to a lot of people and pitch your story and always ask for how many other people they can introduce you to.
And I would add, for students especially, to go out there and attend these events. Mass Challenge might have an event, Diving, Capital Factory, all of these places, they'll have multiple events throughout the year that are open to the public. And oftentimes I'll tell my students, just go out there and start shaking hands, don't stand in a corner. And that's the only way you start networking. Madison's getting her workout for the day.
Thank you guys for coming. I am a new entrepreneur in corporate clothing. I practiced law for 10 years in the oil and gas industry, so my entire world was steeped in realism. And one of the things that I have found somewhat unsettling kind of going into this new space is when you start looking at fundraising, people ask you about the money you expect to make. So I'm comfortable providing information about the market size and what the potential opportunity is, but when they start asking about, your 5, 10, 15-year outlook, it seems as if entrepreneurs are just kind of reaching out of thin air. And I'm kind of wondering how much stock do you put into that when an entrepreneur pitches to you? So when they say, we expect to make $50 million in the next 3 years, what do you think of that? As
a startup?
Yeah.
I put zero stock in that. Because I have no idea, and you have no idea how big. If there's a big enough market opportunity, there's the potential, and that's, I think the investors are always trying to figure out what's the real market, and if you have a niche today, can you grow that into another one tomorrow and sort of expand your business plan, your total available market, and getting it down to an addressable market. But if anybody tells you that I'm going to make $50 million in the next year, 5 years, 10 years, They have no idea. You don't. There's too many things that are going to change along the road. You're going to change your business plan multiple times. You may change the product completely. You're going to pivot. And when you're starting out early, I think it's just an unrealistic question. You can demonstrate that you have a big market opportunity. You think you have the right product market fit. You think you've got the right team to do it. You're going to be confident in your pitch, but promising somebody, a return or a certain size in some number of years is just a fantasy to me. But
yeah, and I just add, so I agree 100% with what John just said. I think when asked that question, if I were to ask that question or you to provide that type of information, what I'm more looking for is two things. One is just the thought that's gone into what your revenue trajectory would look like. How do you think about pricing? How do you think about your customer? How do you think about acquiring that customer? So it's just showing the level of thought that you've put into whatever numbers are there. Like I said, like John, I sort of put zero stock in the actual numbers themselves. I just want to understand what's your pathway to growth and have you thought through it? And then two is just knowing, I learn a lot about your ambition as an entrepreneur as well.
Thank you.
That's great. Yeah, that's a great point.
Next to you. Go ahead.
You talked a bit earlier about PRIs, program-related investments. What is the biggest thing you can think of that could help trigger the release of more of those PRI investments?
Regulation. Regulation. Right now, so to provide some context for those who may not be as familiar, it was mentioned earlier in the panel, a program-related investment is an investment that a foundation can make, but they are investments that are made out of what they would otherwise give away, which at this point is 5% of what they're endowed. So that was another stat that was shared earlier. So that means if you're $1 billion investment, only 5% is being given away, and you are allowed to make some of that in the form of a PRI. And the legislation around what qualifies as a PRI is challenging enough that it's not, it's too difficult, I would say, of a learning curve for a lot of particularly smaller foundations to get up. They don't have people in-house who know how to make investments. Those people live in the endowment. They are usually in a separate building or in a separate office and don't even talk to the people who run the program. And then two, the level of justification you have to go through to actually qualify to the IRS, who is the one that determines whether or not it's a PRI, is really difficult. So until either those, the PRI laws are changed, I think two things would really unleash that. One is making the PRI laws more flexible and accessible to smaller foundations, and then two, probably regulation that would either increase the amount that foundations should be deploying every year as a giving matter, and then making PRIs a fixed part of that.
And even maybe just like a step even more basic, PRI, if you make a loan to to a charter school for a facility, and it's extremely risky, and you're only going to make 3% on that loan, in no way, shape, or form would you ever make that with your fiduciary responsibility. But with the PRI, you can then make that, or maybe that's an MRI. But with the PRI, you can make that loan, and if you lose that money, it would just goes into the money that you would have granted. So it really allows for a foundation to almost take a free pass at an investment and do something much riskier or a much lower return profile than they would have done otherwise.
Yeah. I'll share a funny anecdote about this. So while I was at JP Morgan, we actually created a capability for JP Morgan's foundation to do PRIs, and my team actually managed those. But when we were in the process of going through setting up even like the process itself to actually be able to do that and getting the approvals we needed internally, I remember sitting down with our accounting people who manage the foundation and saying, so we're gonna do this thing called PRIs. They're like, that's great. And I'm like, so we invest some money? And they're like, yep, we got that. And that's like, and then it comes back. And they're like, oh no, it can't come back. It's like, we don't know how to book that. So there's even like these things around accounting and back office, as silly as they seem. It's just like, we know how to write it so that it goes away, but when it comes back, that like throws our books out of whack. So anyways.
Do we have any more time, Ashley? The Twitter prize, yes. Okay.
To join us for some food and drinks after. The winner of the Twitter competition, if they would like to come up, is Katie Pereira.
Yeah.
I can also
Katie, Katie, congratulations. David, John, Amy, thank you for unpacking impact investing, and we'll have you back to unpack it further next time. How's that? Thank you very much for spending some time with us, and thank you all for attending.